The broadcast is now starting. All attendees are in listen-only mode.
Good evening, friends, and welcome on this GST 2.0 era. So today we meet for change we'll turn the change into chance. GST 2.0 touches rate cuts, refunds, many rules we have seen already. There are many circular also out. Rate change will effective from 22nd September as well. So our promise today's session will give your clear facts and simple steps. Clarity begins and the action beats the entire anxiety as well. So let's learn today, protects our client for tomorrow, and it's my proud privilege to welcome our today's speaker, Advocate Chartered Accountant Abhay Desai sir. We are very thankful to you, sir, for joining us and being here, sharing your valuable knowledge, giving all of us your valuable time, sir. So, sir is a partner at Desai Legal, which is leading GST litigator in the country. Sir has already litigated more than 1,000 plus high court cases, tribunal cases. Sir has turned complex law into very simple action as well. I know sir since long. I think since 2015, and around it's 10 years now. And recently, I met sir at BKC also, where sir has taken the session at ICI WRC as well. Very practical, very precise, and again a very try and tested method is used by sir. We are very lucky to learn from him, so would like to request everyone to welcome him, a virtual welcome for Abhay Desai sir. Thank you once again, sir. Sir, let me tell you the your popularity. We have more than 750 plus registration today, and will expect that they will join in large numbers, and many will watch the recording. I have already received many requests that they are outstation and may not able to join. They will try to join, but will they require the presentation as well. So we have already around 150 people are already joined. Few people will join in a time. Would like to play a small video of Connect Easy journey, and after that we'll start our today's session. A small video what professional and the leaders in the profession has to say about us. A small video. Welcome back, friends. And let me just, who has just joined, let me introduce once again to Abhay Desai, sir. Sir is obviously a very known personality in our profession, partner at Desai Legal, leading GST litigator, 1,000+ High Court and Tribunal cases. Sir has turns complex law into very simple action, practical, precise, and battle tested. The methodology of teaching, we are very lucky to have him. Would like to request each and everyone who is watching live on GoToWebinar or live on YouTube as well to connect Abhay Desai sir on LinkedIn, a professional network, world's largest professional network. So with this word, would like to request Abhay sir to take the proceeding ahead for our today's session. Over to you, sir. Thank you.
Thank you so much, Virag bhai, and good evening to all of you. It is indeed my pleasure. In fact, I am lucky, although Virag bhai says that he is lucky, but the real fact is otherwise. In fact, I am lucky to be able to participate on his platform and to be able to share some of my thoughts on the recent substantial developments that have taken place in the context of GST law. And I'm also lucky that the video he played echoes what I wanted to say and share about him. His passion for sharing the knowledge, his passion for creating this platform and inviting persons like me to share some of the thoughts. In today's day and age, it is rare that someone will put in so much of effort and time to organize such webinars. So, best compliments to him. Now, friends, coming to my topic, as Virag bhai rightly said, that it is GST 2.0, and that is what the GST Council and the government has also indicated. In fact, as you are all aware, it started on 15th August 2025 when the Honorable Prime Minister from the Red Fort indicated that substantial GST reforms are on the way. A substantial reduction in the rates of taxes is on the way. And in spirit of that decision, the GST Council met on the 3rd and 4th of this month. In fact, originally the meeting was planned for 2 days, but as you all are aware that on the first day itself, that is on the 3rd of September, late night the meeting concluded and there was a unanimous decision on all the proposals that were put before the council. And around 10:40 in the night, we all received a press release from the GST Council running into hundreds of pages, indicating a massive cut in the rates of GST, in more particularly in the context of goods, indicating that we are moving to a simpler structure, indicating that we are moving to a structure where the government is hoping that with a lower rate of tax, the compliance would increase, and therefore the temporary shortfall in the revenue that the government would get compensated with the increase in demands, with the increase in the consumption. And normally we have seen that whenever there is a rate cut, especially in the context of GST, we often find that as against what someone may logically feel that there should be a reduction in the revenue going forward, but effectively it happens that the revenue increases over a period of time. All of you must have experienced that in 2019 we had a similar rate cut, not on the scale at which the rate cut has happened during this time, but there also substantially many goods which were under 28% bracket were brought under the 18% category, mainly consumer facing goods, and there also there was an apprehension that the GST revenue would dip substantially. But as you all know that today, as we speak, the revenues in a ordinary situation has crossed around 2 lakh crores monthly. Obviously, we will see an impact of this rate cut in the coming months in the short term. But I feel that over a longer period of time, with the rate cut, there should be a push to the consumption, there should be a push to the compliance, because normally, culturally, we feel that whenever there is a higher tax which is charged on the invoice, there is a tendency amongst all of us to avoid that tax, and therefore there is a tendency to either undervalue the transactions, either to undertake the transactions without due payment of tax, etc., etc. So therefore, that results into committing a lot of offences, non-compliances under the law. But with a lower rate of tax, psychologically, the tendency to avoid an invoice, the tendency, this is largely at the B2C stage, that is the consumption stage, the tendency to avoid paying taxes on those transactions gets substantially reduced. And therefore, I see that with this massive cut that has happened, which will now come into effect from 22nd of this month, to that extent, we'll see in that sense a greater compliance, a greater revenue for the government in due course of time as we progress ahead in our march to becoming a developed economy. So with that background, let me start the presentation. The presentation is not in the PPT format. The reason is simple, that this is perhaps the first webinar where we are going to discuss the actual notifications which have been issued. Prior to 2 days, whenever I addressed sessions on this topic, it was more based on the press release, and therefore the talks were more general in nature. Now we have the notifications in place, we have the circular in place, we have certain orders, certain FAQs in place, which are throwing certain lights on certain controversies that are likely to arise because of these changes, and therefore we now have a much better idea as to what we are going to get into from 22nd of this month. And therefore, to that extent, I feel that such sessions based on actual notifications and circular would add far more value in times to come, as against cases where the discussions were largely based on the press release. So therefore, I'll just try to share my screen. So therefore, largely okay. So largely, this is what you can see on your screen is a compilation of the documents which have been issued by the government, be it the notifications or the circular or the FAQ. As you can see, the total, it runs into 257 pages. It's a voluminous information which has been made available to us, which we will have to digest, understand, interpret, and apply within next 3 days, because as you are aware that the rate changes are coming into effect from 22nd of this month. So with that in mind, before I get into the notifications per se, let me just indicate a broad overview of the two aspects which would be relevant for all of us to understand. As you understand that largely there has been a rate cut, only on few items there has been an effective increase in the rate of tax. And therefore, whenever there is a rate cut, the common questions that come to all of us is the question of profiteering and the question of how do we apply the new rates vis-a-vis old rates for the transactions which are in process. So as far as the profiteering is concerned, there is a provision which was made under the CGST Act in terms of section 171. This provision was made to take care of situations when our country shifted from the pre-GST era to the GST era, where under the earlier era there was a levy of excise duty, service tax and VAT, and all of that got merged in the context of GST, and that is where the council felt that because of this transition, the benefit that might accrue because of this reduction in the effective rate of tax under the GST regime would not get passed on to the consumers, the end users, and therefore the council felt that there was a need of anti-profiteering provisions in law, whereby if the suppliers do not pass the benefit in terms of reduction in the rate of tax or the benefit in terms of availability of larger pool of input tax credit as opposed to the pre-GST regime, in that situation the suppliers were expected to pass the benefits to the consumer, and remedy was created in the form of consumer being permitted to file complaints, applications before the authority, the anti-profiteering authority at the initial point in time. And the anti-profiteering authority was supposed to scrutinize those applications, and wherever they deemed fit, they used to direct the investigation by the Director General of Anti-Profiteering, who in turn would then present a report measuring the benefit or the rate reduction which has not been passed on to the consumer, and basis those report, the final orders used to be passed, directing the supplier to pass on those benefits. Number one. Uh, at a later point of time, provisions were also created for the purpose of asking the suppliers to pay interest on the late passing of these benefits. And then there was provisions which penalizes the suppliers for committing this offense of not passing on these benefits, and therefore penalty consequences were also attracted. Today, as we find that anti-profiteering authority was ultimately then disbanded, the Competition Commission of India was given that role, and then today, as we all are aware, that it is the GST Tribunal which will eventually be adjudicating these cases. Till date, almost all the cases are pending the adjudication, because nowhere the suppliers have accepted that they have committed this offense of not passing on the benefits. And also the fact that suppliers are contending that even if you are expected to pass on the benefits, the methodology to pass on the benefits as applied by the competent authority was incorrect, because as many of you would be aware that it is not that simple enough to just pass on or to compute the benefit merely basis the rate cut or merely basis the larger availability of input tax credit. There are many other factors which are required to be considered. As an example, we will see later in our discussion that with a reduction in the rate, the inversion increases. The scenarios where there is an inverted rate structure gets aggravated. And today, as we speak, there is a limitation under the law where only the refund on the accumulated credit on inputs is available under the inverted rate structure, meaning thereby that the refund of accumulated credit on services and capital goods is blocked, which eventually results into increase in cost to that extent for the suppliers, which eventually to some extent negates the benefit of the rate cut. And therefore, in that sense, the effective benefit which is required to be passed on to the consumer is always something which is debatable, something for which there is no standard methodology available. It may also vary from suppliers to supplier. And there are also market forces which decide, because which decides the price that one is willing to pay to buy those goods or services, and therefore these external factors also have a larger play. That things get aggravated in a real estate sector because that project runs over a period of over a longer period of time, and therefore there is always a disharmony between the output supply vis-a-vis the availability of input tax credits, and therefore there also a simple formula of comparing the credits with turnover of the pre-GST era with the post-GST era will not yield the correct result as regards the actual benefit which the developers or builders might have enjoyed on account of introduction of GST. So all those disputes are, as we speak, pending before the GST Tribunal. And as you might be aware, the GST Tribunal, it is expected to start functioning probably by end of this year or early next year, and therefore only with times to come, the GST Tribunal will decide those issues. Now, when we look at this provision and look at the present situation, whether is it necessary for the suppliers to pass on the benefits of the rate cut to the consumers? If you look at section 171 subsection 2, it permitted the consumers, the recipients, to make an application wherever they find that they have not received the due benefits. Now that procedure of accepting the application had a sunset clause, and it has already ended on 31st March of this financial year 2025. Therefore, as we speak, there is no provision under the GST Act which permits the consumers or the recipients to file any official complaints or applications before any authority if they feel that the benefit of the rate reduction, which has now happened from 22nd of this month, has not been passed on to the said recipient or to the consumers at large. So legally speaking, there is no provision which in a way compels the suppliers to pass on the benefits of the rate reduction to the consumers or to the recipients, uh, and therefore to that extent, on first principles, I would say that if someone does not pass the entire benefit of rate reduction to the consumers, then probably one under the eyes of GST law cannot be said to have committed an offense. Having said that, there is a caveat which has to be understood, that there are certain authorities which control the pricing in certain sectors. For example, in the pharma sector, we have the pharma laws wherein there are authorities which have the power to regulate the prices. Now, those authorities have issued notifications recently where they have mandated that in this particular scenario where there is a rate cut, the suppliers have to reduce their prices of drugs and medicines, and accordingly they will have to supply the drugs and medicines from 22nd of this month at the reduced prices. So if you are facing or you are operating in a sector where there are pricing controls through the provisions of the law, and if those pricing controls mandate that the benefits are required to be passed on to the consumer, then those provisions would come into effect. And therefore, if someone commits an offense by ignoring those provisions of law, then there are consequences that one might have to face under those respective laws. But as I indicated, as far as the GST Act is concerned, as we speak, in absence of any provision permitting or compelling the suppliers to pass on the benefits, to that extent, I would like to clarify my thoughts on this aspect, that as on date, there is no compulsion, so as to speak, apart from the fact that the whole idea of the GST Council is to ensure that the benefit gets passed on to the consumers. And we have seen the Honorable Finance Minister also indicating that we are going to monitor the prices. And then we have also recently come across a CBIC directive issued to commissionerates across India, where they have said that in the context of 54 essential items, they are supposed to, on a monthly basis for next 6 months, pass on a priority basis the prices pre-GST cut and post-GST cut, perhaps for the ministry or the board to supervise these changes. So in that background, if because of the competitive factors, because of other reasons, if someone has to pass on the benefit, the supplier are required to pass on those benefits. But strictly from a perspective of GST law, as on date, Section 171 does not operate, and therefore, in that context, there is no mandate under the GST Act to pass on the benefits. So that is on the first aspect. Second, the new rate comes into effect from 22nd. We are on 19th, so we still have 2 days in which the certain transactions would happen. There would be certain transactions which would be in transit. Now, let me first deal with the smaller issue and then on the larger issue. The smaller issue is about e-way bills. Let us say today your particular goods attract GST at the rate of 18% or 12%, and from 22nd it would become 5%. In that situation, if you make an invoice, let us say today or tomorrow, and if you dispatch the goods, and let us say you are dispatching the goods to a location which will take 4 or 5 days for goods to travel and reach the destination. So by the time the goods will reach the destination, those goods will attract 5% GST. Your invoice will carry today's rate of tax. Your invoice will carry accordingly the tax value. Then is there a requirement to revise the e-way bill or to furnish a new e-way bill on the midnight of 21st, in the sense that at 12 o'clock of 21st, when the day will change to 22nd, to generate a new e-way bill with the new rate of tax? Is there a requirement? The answer is clear, no. In fact, if you see the provisions of the law, the requirement of issuing the e-way bill arises at the time of dispatch. Therefore, today when you are dispatching the goods, if the item attracts the GST of 18%, then e-way bill has to be prepared at 18%. And accordingly, there is no requirement, even if those goods reach the destination after 22nd, to revise the e-way bill or to furnish a new e-way bill. The current e-way bill, as long as it is valid, will survive and will be considered as a valid e-way bill for the entire journey. And in fact, this aspect has also been clarified in one of the FAQ, which is part of this compilation. I will also share this compilation with Virag Bhai, who can in turn share it with all of the participants on your email IDs, which you might have registered with. And therefore, the FAQ is right in that sense to say that in such situation, there is no requirement of a new e-way bill. Now, let me take up the larger issue. The larger issue is the applicability of the rate of tax. Which rate will apply, whether the old rate or the new rate? Now, to answer that question, we have to look at the provisions contained under Section 14 of the CGST Act. This deals with a situation where there is a change in the rate of tax. Essentially, the provision talks about three situations which are required to be considered: when the supply happened, when the invoice was issued, and when the payment was received. And if any of the two situations happen prior to 22nd, then the old rate would apply. If any of the two situations happen on or after 22nd, then the new rate would apply. Now, as far as the situation of invoice and payment is concerned, it is very clear. The invoice, the date of invoice would be the date which would be reckoned for the purpose of applying that factor, and the payment, the date on which you have actually received the money, that would be the factor that would be taken into account as far as the factor is concerned. The question arises as regards the third factor, that is the date of supply. When can we say that the supply has taken place? If you look at the charging provisions, the levy of tax is on supply, and various forms of supply have been recognized. If you are talking about a situation where the supply is in the nature of sale, then in that context, to my mind, a supply can be said to have taken place only when there is a transfer of title in goods, because the underlying supply basis which the charging provisions are attracted is in the nature of sale. So in that context, if your contract says that the title will transfer when the goods leave your premises, and if the goods are leaving today, then in that situation, one can say that the date of supply would be on 19th of September and not 22nd of September, when the goods might reach the customer premises. However, if your contract says that the title passes on reaching the goods to the customer's premises, then in that situation, to my mind, the date of supply would be 22nd. So in that situation, even if invoice is issued today, if the supply happens on 22nd, payment is also received on 22nd or thereafter, then to my mind, the new rate of tax would be applicable, not the old rate of tax. So in that situation, if someone today makes an invoice at a higher rate, then one would be right in issuing a credit note, tax credit note, to the extent of the rate difference that for which he would have to then adjust his price for the supply, because actual rate of tax would be lower than what he is charging on the invoice which is generated today. So this is what one has to consider while applying the new rates of tax as far as the transition is concerned. The third aspect that I wanted to deal with is with respect to the credit notes and debit notes for the transactions which have already happened prior to 22nd. Which rate of tax would be applicable? If you look at the entire concept of credit notes and debit notes, those are the documents which do not underlie a new transaction. They are not the documents which signify a new taxing event which has taken place under the law. The taxing event has already taken place when you had supplied the underlying goods or services at the relevant point in time. So if you had supplied the relevant goods, let us say on 15th of this September, and under the contract, if you reserve the right to issue a debit note on account of some rate variation, and that debit note is issued on or after 22nd, to my mind, the rate of tax would be the date on which the supply actually took place, which is on 15th of this month. And therefore, if on that day the rate of tax was 18%, then even if the debit note is issued on 25th of September, in this context, the rate of tax would be 18% and not the 5%, which might be the new rate of tax that might be applied on that particular item. Similarly, if let us say there is a credit note which is to be issued pertaining to discounts or rate differences or return of goods, in that context also the credit notes would carry the old rate if the transaction has happened in the prior to 22nd of this month. So if the supply has happened on 15th of this month, and if the goods are returned back on 22nd of this month or 25th of this month, or if there is a discount which is to be granted basis the supply that has happened prior to 22nd, then all those tax credit notes will contain the old rate of tax. It will not contain the new rate of tax. So that again something that one has to understand and keep it in mind. Now, debit notes may also be issued for the purpose of recovering the interest amount, because in many contracts there are provisions which indicates that if there is a late payment, then there is a liability on the recipient to pay interest on the delayed payment of consideration. Now, under the law, the interest which is received on delayed payment is also considered as a part of consideration which is liable to tax. However, the time of supply, that is the time at which the liability to pay tax arises, is the time of receipt of the interest amount. In this context also, if let us say the supply has happened on 15th of September, if the due date was let us say on 25th of September and the payment is received let us say somewhere in October or November, and because of delayed payment you have a right to receive interest, and accordingly you issue a debit note and you actually receive the interest in the month of November. Since the original supply happened prior to 22nd of this month, to my mind the rate of tax that would be applicable on the debit note would be the old rate of tax, which is let us say 18%, even if the debit note is issued in the month of November, and not the new rate of tax which might be applicable at that point of time, which would be lower than the present rate of tax. So this is what I wanted to share on the debit notes and credit notes as far as the change is concerned. Now with this three issues taken care of, let me now go to the compilation, and let me take you all through the major notifications and the significant aspects of that notification, so that all of us can appreciate how effectively the decisions which have been taken have come out in the law, and how and what are the consequences, or what are the issues that one might have to come across and understand while interpreting this notification. So with that in mind, as you can see, there is an index where we have tabulated the notifications under two broad categories. First, we are going to discuss the non-tariff notifications, which does not affect the rate of tax, but it affects either the provisions related to refunds, either the provisions related to filing of annual returns, either the provisions related to the format in which the annual returns are to be filed, etc., etc. We are also going to touch upon very briefly the notification wherein certain provisions, certain important provisions of the Finance Act 2025 have been brought into effect. So that also we will briefly consider this as a part of non-tariff notifications. Of course, these non-tariff notifications, all of these notifications will not come into place from 22nd of this month. Each notification has indicated a specified date from which it will come into effect, and therefore one has to also keep that in mind while understanding and implementing this non-tariff notifications. Then we look at the tariff notifications. All the tariff notifications will come into effect from 22nd of this month. So as you can see on the screen, from serial number 7 to serial number 15 are the CGST tariff notifications, and from serial number 16 to serial number 24 are the IGST tariff notifications. Then we have one notification related to Cess, compensation Cess, because there are also some major developments have taken place, and there are major issues that are required to be considered while understanding and implementing this notification. So that is also that we will consider. And then we have one circular which have been issued relating to the post supply discounts, how the discounts are to be treated under the GST law. And then we have three sets of FAQs which have been issued by the board till date, clarifying on certain aspects related to the changes which have taken place. So this would be largely our discussion. So let us begin. So the first notification is 13/2015. It is a non-tariff notification dealing with the amendment in the CGST rules. The major amendment that you can see is in the context of the ISD provisions, where as you are aware that the input service distributor provisions have been made mandatory from 1st April of this year 2025. Now there are certain drafting lacunas in the mechanism that has been prescribed under the rule, whereby the tax paid under reverse charge, which was required to be distributed through the ISD mechanism, only covered the tax which was paid on the intrastate supply, that is the SGST and CGST supply. It did not cover expressly the IGST payments under reverse charge, and therefore to that effect a retrospective amendment has been made in the rule to provide that under the ISD mechanism, even the reverse charge which might be paid under the IGST Act by the regular registration number would be able to then pass on under the ISD registration to and then henceforth to the recipients of under that same PAN. Another important change that will come into effect from 1st October 2025 is in terms of Rule 91. Now, let me just pause here and indicate a background about this rule. So, under the GST law, we have refund provisions which are contained under Section 54 of the CGST Act. As far as the refund related to accumulated input tax credits are concerned, the law provides for the refund in two situations. One is where the person is making zero rated supplies, and the other is where the person is making supplies under the inverted rate structure. Where the inverted rate structure has been understood as a structure where the rate of tax on inputs is higher than the rate of tax on output supplies. So it is in these two categories that the refunds are available. Now, in the context of zero rated supplies, presently Section 54 subsection 6 provides that when a person makes an application and there is an acknowledgement that is issued by the authority accepting that application, then in that context, within 7 days from the issuance of the acknowledgement, the authority is expected to provisionally release 90% of the refund which has been claimed by that registered person, and the order in which that refunds would be provisional refunds would be issued would be RFD 04. Now, what the council has understood that since because of the massive changes in the rates that will now take place from 22nd of this month, there will be a lot of blockage of capital under the inverted rate structure, because a lot of the goods which were otherwise attracting 12% have been all shifted to 5%. However, their input services continues to remain at 18%. Therefore, there will be an increase in the situations where there will be inverted rate structure, and therefore to mitigate that, as on date, there is no provision which permits the authorities to provisionally grant 90% of the refund under the inverted rate structure. So, council has proposed two things. There will be an amendment in the act. We are yet to see that amendment, but it is hoped that that amendment should happen soon, because this amendment in the procedural part, as far as the sanctioning of this 90% refund is concerned, that is sought to be applied from 1st October 2025. So really it looks challenging, because in this short span of time to bring an amendment under Section 54(6) to also cover cases of inverted rate structure for the purpose of granting provisional refunds will be required, and only thereafter those assessees, taxpayers would be able to claim those refunds. If the legislative amendment doesn't happen by 1st of October of 2025, then only the persons who are making zero rated supplies, as is what the case today, would only continue to be able to avail the provisional refunds. The refunds under inverted rate would continue to remain as per the current scheme, where only after the final sanction order the refund amount would get disbursed. Now, what the rule effectively further provides, that this provisional refund, which would be sanctioned within 7 days from the date of acknowledgement, that would be sanctioned to only to those assessees where, on the basis of the risk evaluation and identification by the system, they are not falling under the restricted category. So a system would be brought in place which probably will have certain criteria. Till date, we don't know what are those criteria basis which the identification of this risk will happen. Today, as we speak in law, the only criteria basis which the risk is identified under Rule 90, 91 sub Rule 2, as it stands today, is that where the said supplier who is making zero rated supply has been prosecuted for an offence under the GST law, where the quantum of offence is about 2 crores. So that is the only criteria today that we have to restrict the disbursement of provisional refunds. But now they are expanding the ambit, and therefore I believe the newer criteria would come into place, and basis which the risky suppliers would get identified, and to those suppliers the provisional refunds would get restricted. All other suppliers would be able to avail of the provisional refunds. Wherever the officer is not granting the provisional refunds, because as per the view of the officer, the suppliers are risky, the new rule mandates that the reasons will have to be recorded for not granting the refunds, Perhaps this is again to bring a transparent system whereby basis the examination of reasons, if someone is aggrieved by that order, then a remedy would be available under the law. Of course, this would not be an adjudication, so therefore the appellate remedy would not be available because this is not an adjudication order, but a writ remedy would be available where a petition can be filed before the jurisdictional high courts, testing the sanctity or the overall context in which whether the officer has rightly exercised the power of refusing to sanction the provisional refund. So it is in that context that the reasons will have to be provided by that officer in writing, so as for the concerned person and for the courts to examine the sanctity of those reasons. So it is in that context that Rule 91 Sub Rule 2 is will be implemented. Then we see certain changes in the rules related to tribunal, because as you all know, GST tribunal would start operating hopefully soon. So it is in that context that certain rules have been amended where certain procedural changes have been made as regards the forms in which the appeals will be filed and the forms in which the acknowledgements would be issued. There is a procedural rule which is inserted in terms of Rule 110A, where, as you are aware, today the structure of tribunal is that the single member bench will be hearing cases where the quantum of tax dispute or the dispute of input tax credit does not exceed 50 lakhs and where there is no question of law involved. Who will decide whether a question of law is involved or not? So it is in that context that Rule 110 capital A is inserted, where now the president or the vice president of the concerned bench, if he is authorized, will decide where the question of law is not involved, and accordingly those matters will get transferred to a single judge, single member bench, and that single member bench will then adjudicate that appeal. Of course, there are certain exceptions whereby the new rule says that if for the same assessee for a different time period, if the appeal is already pending or heard by a division bench which comprises of technical and judicial members, then the matter would get travelled to the division bench, even if in that particular matter the quantum involved of dispute is below the limit of 50 lakhs. So it is in that context that the rules have been formulated. Then we see substantial changes in the form GSTR-9. Now this is something which one will have to understand. Look, today the difficulty of the form GSTR-9 when it comes to table 6 is that the input tax credit which is availed by the person in 3B and which is then considered by the form at a later point of time under table 8 for comparison with ITC that gets auto populated from 2B is a flawed comparison because it ignores the timing element. It ignores that as to what is the document date and when the credit was claimed. For example, pertaining to 24-25 financial year. If someone avails the credit in that financial year, but the underlying invoices or the underlying bill of entry is of the preceding financial year. Now, in that context, today the design of the form was like this, that the entire credit comes in as part of table 6 and accordingly that credit eventually then flows for comparison, and that resulted into flawed comparison. There was no column separately available for distinguishing this credit which is availed in the current financial year as regards how much pertains to that financial year and how much pertains to the preceding financial year. So that aspect is now taken care of. Now we see a new revised table 6 where we will have now a separate column under 6A where the total input tax credit which gets auto-populated from GSTR 3B will have to be further segregated based on the period to which it pertains, and accordingly subsequently only the credit which pertains to this particular current financial year would then be considered for the purpose of making a comparison under table 8 with the ITC which gets auto-reflected from GSTR 2B, that is from the filings which are done by the vendors of the taxpayer. So that is how the form is sought to be restructured. The form is also sought to be restructured in terms of creating a separate space for disclosing ITC which is availed through these separate forms such as ITC 01, 02, 02A, which deals with situations resulting in the transfer of business, etc., which covers under section 18. So it is in that context that separate columns with a specific indication of the form through which that ITC is availed is required to be indicated here. Then we see that again there is a exclusion of ITC on related to import of goods, which is availed in the next financial year, so that again when that comparison is made when it comes to the total amount of IGST which is paid on import of goods vis-a-vis what is availed in that financial year, that comparison becomes more logical by excluding the ITC related to the import of goods, which the tax would have been paid in this financial year, but the credit would have been availed in the next financial year. In terms of table part 4, the table 9, we see that today the form did not have a separate column indicating the difference between what was payable and what was paid. As you are aware now, annual return as far as table 4, 5, 6, 7, the 4 and 5, where you disclose the output tax liability, they are to be filled up based on your actual data, based on the records which are maintained by the taxpayer. And therefore there are situations where the tax payable basis those data would fall short of what has actually been paid, because at the time of annual return you might have detected certain liability which might have been skipped at the time of filing the monthly returns, etc. So there was no separate column which used to bring out this difference. The table was already there in the form comparing the tax payable with tax paid, but then there was no column specifically bringing out the difference. Now, as you can see on the screen, a notification is going to replace that table with the revised table, which will now have the separate column at the end of this table indicating and bringing out this difference. And then, of course, you will be have to ultimately answer as to how that difference has been considered and paid by the concerned taxpayer. Then when it came to disclosing the transactions which spill over under the next financial year, we did not have a separate column pertaining to the input tax credit adjustments. That is now sought to be introduced, and the differential tax on account of those subsequent year adjustments again only had the payable and paid column, but not the difference column. The difference was never captured by the form. Again, that table is sought to be recast for capturing that difference. All those exemptions which are there since the inception of GST still continues for financial year 24-25. So as you might be aware that there are certain tables in annual return where the law does not mandate filling up those tables. So as you can see on your screen, there are tables related to declaring the details related to refunds, etc., declaring details related to the how much you have received from composition taxpayers, etc., etc. So all those exceptions which are there, which have been there since the GST was introduced, still have been extended even for this financial year 24-25. Please understand, these changes what we are discussing will be applicable for the filings which will be done for financial year 24-25. The reason is these changes are brought into effect from 1st October. Of course, till date, we see there are no forms which are available on the portal. With these changes, the revised forms would come on the portal, and accordingly, those revised forms would be applicable for financial year 24-25. So it is only hoped that the GST, the department, brings these forms at the earliest, because as you can see, the revised forms will require more data to be captured. Again, this relates to the last financial year, so many taxpayers will have to probably expend efforts to find out the additional data which is now sought under the revised forms and fill up those forms. And then if there is a delay in bringing those forms on the portal, then that will result into a lot of unnecessary stress and burden on the taxpayers as well as the tax practitioners, chartered accountants, consultants, etc., in terms of filing those forms before the deadline, which ends on 31st December of this year. So it is hoped that now with this notification in place, the GST, the portal works on these changes at the earliest and brings out the revised form. At the same time, the taxpayers are also advised to start working on these revised requirements for financial year 24-25, so that by the time the forms are available, the taxpayers might be in a position to have those data available to fill up these additional requirements which have now come into place because of this changes. As far as 9C is concerned, the change relates mainly to declaring separately the tax on which the transactions on which the tax is paid by the e-commerce operators. As many would be aware that under section 9(5), a separate liability has been cast on e-commerce operators to pay tax on supplies which are made through such e-commerce operators. And it is in that context that there was a need of disclosing those supplies separately. In the annual returns, there was already in the monthly returns, the respective changes were made last year, and therefore the same changes are now also brought in 9C by indicating the separate columns wherever the output tax or output supplies are required to be disclosed. There is an additional column which is inserted in the context of late fees, which was not there in the present form, which will, so I believe the form will calculate the late fee probably on the late filing of the annual return, and accordingly include those figures here, and probably compel the taxpayers to pay those amounts at that stage of filing of this 9C form. Table number 14, which was a reconciliation of input tax credit with the expenditure which has been booked in the records. That exception has been made of not filing that table. That exception still continues for this financial year 24-25. So the table number 14, which is always a challenge, that is again not required to be filled up for financial year 24-25. This notification takes care of that issue and says that those exceptions, as you can see on your screen in terms of Roman 2 capital A, those exceptions continue. So that is something that is welcome. Then these are the forms related to the appeal. Since we have limited time, I will skip these forms. They are largely very exhaustive in nature. Today we have forms where in the context of filing appeals before the CSTAT, where the forms do not capture data to the granular extent to which now the GST appeal forms are expecting to capture the data. The thought process is that the filing would all be online mandatorily of appeals before the GST tribunal. Therefore, even the provision which permitted manual filing has been removed by this particular notification. And even at the in the case of online filing, as you can see on the screen, the form is going to capture a lot of data as regards the nature of dispute, as regards, so that statistically and even for purpose of sorting out the cases, the registry of the tribunal will be in a much better position or much better equipped to find out and tag those kinds of matters under the categories and the subcategories which are there created in the form, so that at the time of disposal, those aspects can also be noted by the registry, and accordingly the cases probably might be placed before the concerned bench. So that is the reason why the forms have been drafted so exhaustively, and therefore even filing this form will require substantial effort and time for in each case to understand exactly where the issues lie, how the issues are to be segregated and indicated section wise, rule wise, and the amount wise, quantum, the disputed amount wise in these forms. In fact, there is a separate requirement of giving a case summary. As you can see on the screen, there is Annexure C which will have to be filled up, where a summary is to be given as regards how the matter progressed from the adjudication stage to the appeal stage. Then there is a separate requirement for giving the case history, as you can see Annexure E, where for each action as to how your proceedings began, you will have to indicate who took the action, under which reference number the action was taken, and a brief narration of that action. Again, all of this is going to assist the registry and the tribunal benches to have a better idea and a better context of the background in which the particular dispute has arisen. So it is in that context that forms have been developed very exhaustively. Separate forms have been developed for filing cross objections, etc., etc. So this, I think, all of you can at the start noting. Those who are intending to file appeal before the GST tribunal, a window is yet to open. But again, capturing data as per these forms is something that will be required, and accordingly that will happen. Now, another notification that we want to discuss is 14/2025. As I indicated earlier, the provisional refund is available in case of zero rated supplies. Today, we don't have any restricted categories under which the refunds can be restricted, but in the experience of the board, they have found that these are the four items where essentially a lot of fake invoicing is happening. Export invoices are issued either the goods of different nature or a different quality are sent, and accordingly higher refunds than what is due are encashed. So it is in that context that two restrictions are now brought into place. Those who have not done other authentication will not be eligible for provisional refunds. And in the case of these four items, areca nuts, pan masala, tobacco and unmanufactured tobacco substitutes and essential oils, in these four categories, the provisional refunds would be restricted. So in these situations, provisional refunds would not be granted. The refund applications would be duly scrutinized by the officers, and only after the final sanction order is passed, only thereafter the refunds would be disbursed. Again, this notification will come into effect from 1st October of this financial year. Now we have notification 15 by 2025, whereby it exempts all those registered persons whose aggregate turnover is up to rupees 2 crores from filing the annual return. So we have already seen this exception. This exception now continues even for financial year 24-25. So in this financial year, if your aggregate turnover does not exceed 2 crores, then in that situation, there is no legal requirement of filing the annual return for this particular year. Now we have notification 16 by 2025, which brings in certain provisions of the Finance Act, which have been passed by the Parliament. President assent has been received, but now it will be brought into effect. And which are those provisions which will now be brought into effect from 1st of October of 2025? As you can see on your screen, section 121 clauses Roman 2 and 3, 122 to 124 and 126 to 134. Now let me just quickly take you through which are those provisions which will be now brought into effect. So as far as 121 is concerned, Roman 2 and Roman 3, this essentially deals with the definition of a local authority, where the definition is sought to be expanded, and those provisions will now come into effect from 1st October. Roman 3 deals with this new concept of unique identification marking, where in times to come the board will notify that which are those goods on which this unique identification marking is mandatory, and accordingly those persons who are dealing in those goods will have to undertake this process of identification marking. Those provisions are again brought into effect from 1st October. So in times to come we will see a separate notification which will be issued identifying those goods where this unique identification marking would be required. As far as 122, 123 is concerned, this dealt with vouchers, taxability of vouchers. Since now law has been amended where the taxability on vouchers have been deleted, therefore those provisions related to the time of supply has been also omitted. Now 124, this is substantial because this deals with the retrospective amendment to the clause D of section 17.5, where as on date, the clause says that the input tax credit in respect of the goods and services is restricted if they are used for the construction of an immovable property other than plant or machinery. Now, Honorable Supreme Court, in the case of Safari Retreat, has taken a view that the expression plant or machinery will require application of functional test, and accordingly something which is understood as plant or machinery by applying the functional test would prevail and would be an exception, and therefore the credit on those items or credit on inputs or services which are used in making those items would not be restricted. The lawmakers thought otherwise. The lawmakers thought that we have already defined plant and machinery in the provisions, and therefore it is that definition that is required to be applied for the exception which is to be carved out for permitting the claim of credits. Accordingly, a retrospective amendment has been made in effect to say that the word plant or machinery will be now be substituted with the word plant and machinery, and an explanation is also sought to be added to say that it is this substitution that will prevail, notwithstanding anything contained in any judgment or order. So in a way, to override the judgment of Honorable Supreme Court, this retrospective amendment was made, and now this amendment is now brought into effect from 1st October of this month. It is a retrospective amendment. It will come, although it is brought into effect from 1st October 2025, but it will relate back in time and it will be applicable from 1st July 2017. A lot of issues have arisen pursuant to this amendment. Since this is not a session to discuss at length those issues, however, I would just indicate two aspects. that even by substituting this terminology, still the definition of plant and machinery, even if we go by how it has been defined in the law, still requires the application of functional test. And therefore, if someone is able to demonstrate that the subject matter of the construction is plant and machinery applying the functional test, then to my mind, it still will be available for the input tax credit. Secondly, the judgment of safari retreat specifically indicated that in a situation where the property is intended to be let out, in that situation, that restriction of 17.5D cannot apply because this is not on own account, and therefore to that extent, that aspect of the provision remains untouched by the legislature when they have made these retrospective amendments. And therefore, to my mind, that exception still survives. And thirdly, even if let us say someone has clearly availed the credit which is in the nature of plant or machinery as understood in the safari retreat judgment, but now comes out from that exception because of the explanation, because of the definition of plant and machinery which is there in law. The question that used to arise is that whether those persons will be liable to pay interest. We have judgments of Supreme Court in the case of Star India, where the court has taken a view that only when such retrospective amendment is brought into effect, it is only at that point of time that one can say that the liability gets created. And unless there is a retrospective amendment in the interest provision permitting the levy of interest with a retrospective effect, the interest can only be imposed for the date from which those retrospective amendments are brought into effect. So since this amendment is now brought into effect from 1st October of this year, therefore, if let us say someone commits a default in the past and does not pay the liability even after October, only in that situation the interest can be imposed. So these are some aspects of this section 124 of this Finance Act 2025, which is now brought into effect from 1st October of this year. Then we have amendments in section 20, again pertaining to the ISD, where we already dealt with this, where as far as the distribution of tax paid under reverse charge is concerned, even the tax paid under IGST gets covered. Now, this substantial amendment was made under section 34 when it comes to credit notes, where the amendment is to the effect that the reduction in the output tax on account of issuing the tax credit notes would be permitted only if the corresponding input tax credit is reversed by the recipient or not availed by the recipient. Till date, this requirement only was attracted in a situation where the credit notes were in the nature of discounts based on the pre-supply agreement. Now this requirement is now thrusted on all credit notes, be it for discounts or be it for rate difference or be it for goods return or any deficiency in service, etc., etc. So all tax credit notes which are issued on or after 1st October 2025 would now get covered by this new additional requirement, where one has to satisfy that the recipient has also reduced the input tax credit or has not passed on the incidence of the tax to any other third person in the chain of transactions. So it is in that context that this amendment is important, and it comes into effect from 1st October of this financial year. Then we are seeing amendments in section 38. As you are aware that there is a facility of IMS, the invoice management system, which is presently active on the portal. However, there was no law which supported that facility or supported the generation of GSTR 2B by using the IMS facility. The law was sought to be amended in terms of section 38. Now that amended law will come into effect from 1st October 2025. So now we will see that on or after 1st October 2025, once the law section 38 amendment comes into effect, we will see that the IMS would be made mandatory in view of section 38 now becoming a law, effective law from 1st October 2025. Then we have amendments in the appeal provision, where if the order is only demanding penalty, then there is a requirement now to pay 10% as a pre-deposit. That amendment will also come into effect from 1st October of this year. Therefore, any appeals which are filed on or after 1st October of this year will have to now also meet with this requirement of pre-deposit if the order is only seeking to demand penalty without involving any demand of tax. We also have the amendment in terms of Schedule 3, where certain transactions which happens in the free trade zone are retrospectively now considered as neither supply of goods nor supply of services. It's a retrospective amendment which will now come into effect, but it will be effective from 1st July 2017. However, there is another section 134 to this act which says that if someone has paid the tax on those transactions, then the refund of those amounts will not be granted. So largely these are the amendments which, by way of this yesterday's notification 16 by 2025, will now come into place from 1st October of this year. So these are also required to be kept in mind while undertaking the compliances. Now, there are two notifications which have been issued pertaining to the GST Tribunal. One of these notification 4219 indicates that which are the cases which will be heard by the principal bench. Principal bench would be situated at Delhi. So there are cases where, let us say, two or more state benches is already seized of an identical issue, and the president is satisfied. In that situation, those matters will go to the principal bench, or where one or more issue involved is related to the OIDR, there is online database access and retrieval services. In those situations, the principal bench will hear the cases, and where disputes involve related to the ISD distribution, in all those cases, again the authority is vested with now the principal bench to deal with those appeals. Then we are also having this notification 4220, where it says that the appeals before the GST Tribunal is required to be filed on or before the 30th June of this next year 2026. So that is the notified date by which all the appeals will have to be filed wherever the orders have been issued prior to 1st April 2026, and where the orders are issued on or after 1st April 2026, then as per the normal provisions of the law, within 3 months from the date of the communication of the order, the appeal will have to be filed before the GST Tribunal. Now, these are the rate notifications which have come, notification 9 by 2025. Now, very interestingly, one has to see this aspect that look, what the council has wisely done is that instead of amending the existing GST rate notification and tinkering with that, because as I indicated, there are substantial changes have made in the rate have been made related to the rates of tax related to goods. So instead of amending the present notification 1 of 2017, which prescribed the applicable rate of tax on the supply of goods, and notification 2 by 2017, which dealt with the exemptions which are given to the supply of goods. So what the council has done and what the government has effectively executed is that those two notifications, the parent notifications, have been superseded, and fresh notification has been issued, which will now come into effect from 22nd of this month. So this will make the things easier to understand in that sense, because one will have to not keep on jumping back and forth between the present notification and the past notification. The past notification entirely has been given a go by, and the present notification is now what will govern the field from 22nd of this month. As you can see that although the earlier notification has been superseded, the present notification, it says that it supersedes except as respects things done or omitted to be done. So this is a saving clause notification, that if someone has violated the earlier notification, someone has done the things which according to the revenue may be contrary to their understanding of the classification of the underlying goods, or someone has not classified the goods, clandestinely removed the goods, etc., etc. So in respect of all those actions, the liability is saved. So it is not the case as if with this new notification the old liability will go. The old notification will continue to operate up to 21st, and even on or after 22nd. Even if the old notification gets superseded, actions which are required to be taken or which were omitted under the old notification, those still survive, and consequences of those actions still survive. So the taxpayers will have to answer the consequences related to the old notification for the time period up to 21st of this month. So it is in that format that the old notifications have been superseded in the context of goods, and the new notifications have been issued. So as you can see, this is the new notification on the screen which have come, which will now govern the field for all rates of taxes pertaining to goods where the goods are taxable. So as you can see, again, this notification follows the same structure, where we are having schedules attached with this notification, bifurcating the goods into various categories. As you can see, although the council claims that we are moving to a 2-tier structure, but effectively, as you can see on the screen, we still have a 7-tier structure, where we have a rate of GST starting from 0.125%, that is a 0.5%, 3%, 5%, 18%, 40%, and 28%. So these are the 7 tiers of structure that we will still have, although majority of the goods are going to fall under the 5% and the 18% structure, but still the government has retained the other slabs pertaining to certain items, and therefore to that extent those various rates will still continue. The notification also retains the same structure as as was the case as is the case in the past, in terms of indicating under each schedule the serial number, the chapter heading, subheading, or the tariff item, and the description of the goods. And accordingly, one will have to check whether your goods under this notification on or after 22nd of this month satisfy the description as well as the chapter heading, subheading, or tariff item, as the case is indicated in the column 2. Only when your goods satisfy these two requirements, only in that situation, that schedule, the rate attached with that schedule, for example, if your goods are falling in schedule 1, then the rate of 5% which is attached with that schedule would be applicable. So largely, since this is more of a factual determination, so we are not getting more into this issues. As regards what are those items which are covered, I think all of you must have also read in the newspapers, in the media, through WhatsApp, through social media, etc., that largely lot of the consumer items, lot of items related to textile industry, lot of items related to automobiles, lot of items related to consumer facing goods, a lot of items related to cases where agriculture is involved. So a lot of those items have been shifted to 5% category. So obviously inversion will increase, because the items which otherwise attracted 18% will now go largely at 4%, and therefore to that extent the raw material still will attract 18%, services will attract 18%, etc., and therefore the credit accumulation would increase. Now here let me deal with one aspect that is very important. See, on 22nd of this month, there will be a lot of taxpayers who would be saddled with goods which they would have purchased at a higher rate, but now they will be selling it at a lower rate, right? So take the case of an FMCG dealer. FMCG dealer might be having a stock of shampoos, soaps, etc., toothbrushes, etc., which today attracts 18%, but from 22nd will attract 5%. Accordingly, there might be dealers of agriculture equipments which today attracts 12%, but from 22nd of this month will attract 5%. There will be certain dealers, stockists of garments, where today garments above 1,000 attracts a higher rate of GST. Now that limit is increased to 2,500. So only garments and footwear where the price exceeds 2,500, those will attract 18% GST. Rest all garments will attract 5% GST. So we will have those situations where there will be cases of the accumulation of credits. Can refund be claimed of those accumulated credits? Now, if you see the FAQs which have been released, which is part of this compilation, you will note that the board has taken a view, who has issued this FAQ, that refund will not be admissible. Now, my understanding is different. If you look at section 54, subsection 3, more particularly Roman clause 2, what it indicates is that refund would be eligible when your rate of tax on inputs is higher than the rate of tax on output supplies. It does not create a situation where it excludes those cases where the inputs and the outputs are same, right? So we have already seen several high courts taking a view that in such situations, since section 54 subsection 3 does not restrict the refunds just based on the fact that the inputs and the output supplies are same, the circular issued by the board in 2020 indicating and echoing the same point which is now echoed in the FAQ, that refunds would not be available is not in accordance with the law, and therefore to that extent the refunds are admissible. It is only hoped and wished that the government takes back this FAQ, takes back the 2020 circular, because essentially it would be not be fair on one side to lower the tax from 22nd, and at the same time saddle the traders, saddle the intermediaries with this huge accumulated credit, which perhaps will take a lot of time in the normal course for those accumulated credits to get exhausted or to get consumed or utilized for payment of discharging the output tax. So again, something that probably strongly the government should look at, and probably accept the views which have been already echoed by several high courts and which are in line with the parliament made law. And therefore, to that extent, this FAQs is required to be taken back. So this is something which one has to understand. But I would submit that if someone is really facing that situation, you should not surrender your claim. You should file the claim of refund, because if you sit tight and if you don't make the claim, and tomorrow if ultimately the court holds the view that refund is eligible, and by that time the limitation to file the refund claim is already over or the business has stopped, then in that situation the credit would always would not be available for refund. So therefore it is very important that one should assess the quantum of credit that one would be sitting with on 22nd, and then assess how the quantum can get utilized. And if you see that there is no in a near future, if there is no possibility of using those credits, then ideally one should file a refund claim at the earliest. There are chances that the refund would get litigated because of the circular and the FAQ which is in place. But as I indicated, high courts have already taken a view that the refund is eligible. So to that extent, one can consider that, and one should make the claim and not forego the claims. So this is, let me now quickly take you through the other notifications. So this is the long notification, because this, as I indicated, comprehensively now gives a revised rate for all those goods which are taxable under the GST law. Now this also notification ends with the certain explanations. These explanations are similar to the explanations that we had in the current notification, which will now be superseded from 22nd. Explanations are largely in the context of applying the customs rules of interpretation, the understanding of tariff item, subheading, heading and chapter as understood under the first schedule of the Customs Tariff Act. So similar to what we used to do now. Here also, for interpreting this column 2 and column 3, one will have to take recourse to the customs provisions and customs rules of interpretation, explanatory notes to the first schedule to the Customs Tariff Act, and apply that to interpret this notification. Now we have the second notification which supersedes the exemption notification. So there was earlier exemption notification issued for goods in terms of notification 2/2017, that gets superseded, again subject to the saving clause, with the new notification which gives again a separate list of items which would be exempted from GST from 22nd of this month. So again you can see here there are around 172 tariff lines broadly which will enjoy the exemption from 22nd of this a month. Then we have notification 11/2025 which amends 3/2017, which largely deals with certain concessional rates which were given to the supplies which are made to the petrochemical sector, where the concessional rate is sought to be removed now, and from 22nd of this month those supplies will attract the higher rate, the regular rate of 18% on such supplies. We also see notification 12/2025 which amends 8/2018. This is largely in the context of sale of second-hand vehicles, where the notification has brought in a margin scheme where it says that on the margin the supplier has to pay 18% GST when the person sells the second-hand vehicles by comparing the WDV as per the income tax law with the transaction value, and if there is a positive margin, then there was a requirement of discharging GST on at 18% on positive margin. That notification gave reference to the earlier notification of 1 by 2017. Now, since 1 by 2017 gets superseded by 9 by 2025, therefore, to that extent, consequential amendments are made in that notification to now make reference to the new notification prescribing the rates of tax. Then for handicraft items, we had a separate notification which was issued recommending a lower rate of taxes. That notification again gets amended, notification 21 of 2018 with a revised rates of tax for handicraft items, where as you can see on your screen, the rates ranges from 5%, it also goes to 3% for certain handicraft items. So this is the notification which will now govern the rate of tax on supplies of handicraft items from 22nd of this month. As far as these 4 items are concerned, it is very surprising, but as far as these 4 items are concerned, fly ash bricks, fly ash aggregates, fly ash blocks, bricks of fossil fuels or siliceous earths, building bricks, and earthen or roofing tiles. In this 4 set of items, the rate of tax is actually 12%. We all thought that 12% is abolished, but that is not the case. This is the notification which retains the rate of 12%. So this is the 8th category of rates. 7 categories we have already seen in the rate notification 9 by 2025. There is an 8th category which is 12%, which is now prescribed by way of this separate notification pertaining to certain kinds of bricks which are described in this notification. Then we have notification 15 by 2025, which deals with changes related to services. Now, as far as service is concerned, as against what they have done for goods, where they have superseded the earlier notification, since in services there are no major variations which are to be done. Therefore, the original notification for services is now amended. So this is the difference between how the goods notifications have been changed and how service notification has been changed. So this is the amended version of the original service notification. The amendments have been highlighted with red font. I will just take you through the major amendments. As far as hotel accommodation is concerned, there is a major amendment which says that from 22nd of this month, hotel accommodation wherever the rate is not higher than 7,500 per unit per day today attracts GST of 12% with availability of input tax credit. From 22nd of this month will now attract GST at a rate of 5%, but with the condition that the input tax credit will not be available. There is also a consequential amendment in the residual entry under the serial number 7, where it says that for hotel accommodation, wherever the rate is not above 7,500, it is compulsory to apply the rate of 5%. And therefore, many queries have come to us where they have said that can hotel who is going to charge less than 7,500, not higher than 7,500 from 22nd onwards, can they still opt to pay 18% and avail of the input tax credit? The answer is no, because the 18% residual entry, explanation to that entry makes a specific averment to the effect to say that for supplies which are covered under the new Roman 1, which now attracts 5%, those supplies cannot fall under that residual entry of 18%. So to my mind, now the hotels from 22nd of this month, those who are not going to charge above 7,500 in all those kinds of supplies, it will have to pay tax at 5%. Even hotels who are charging more than 7,500, please understand this tariff is not based on declared tariff. So even if that hotel has certain categories of rooms where they charge above 7,500, but certain categories of rooms where they charge, let us say 5,000, on that 5,000, 5% would be applicable. On the higher category rooms above 7,500, 18% would be applicable. Against 5% input tax credit will not be available. Against 18% input tax credit will be available. So for the hotel, those who are going to operate in these two slabs of 5 and 18, there will be a huge challenge for the purpose of identifying the input tax credit which would be available against the 18% supply, and accordingly maintain the records for the purpose of availing those credits. To my mind, ideally the structure should have been simplified. Irrespective of the hotel rate, all of it should have been brought under the 5% category if that is what the council intended, without permitting the credit, or all of it should have been kept under the 18% category with full availability of credit. Creating this mix will pose a huge challenge and huge unwarranted litigation for the hotel industry in times to come as regards the apportionment of the credits. Similar amendments have been made in the transport sector, whereas many might be aware that today we have schemes where in the context of transport sector, one can either opt for a lower rate without input tax credit, accept the input tax credit flowing from the same line of business, and a higher rate with full availability of input tax credit. That higher rate, which was largely 12%, is now increased to 18%. So for example, a GTA, a goods transport agency, who is operating under a forward charge and has opted to pay tax at 12% for availing the full input tax credit, from 22nd onwards, the GTA will have to now operate at the higher rate of 18% for the supplies which are made on or after 22nd of this month. So again, and whether now this GTA can shift to the 5% category, the way the rate notification is structured, to my mind, that shifting is only possible financial year wise. So for this particular financial year 2025-26, since these rates are coming into effect from 22nd of this month, it will not be possible for the GTA to shift from 22nd to the reverse charge or the 5% category. The GTA will have to continue to remain under that forward charge at least till March of this financial year, and probably from next year the GTA can consider by evaluating the pros and cons of whether to remain under the 18% category with full credit or to shift to the 5% category without credit. So again, till now that 5 and 12 was the criteria. Now going forward, it would be 5 and 18. So the gap would be substantial. Therefore, that re-evaluation of that options would be required. Similar amendments have been made in relation to the transport of goods by container by rail. Similar amendments have been made as far as the transportation of natural gas, petroleum products are concerned. Similar amendments have been made in the context of renting of motor vehicle, where again we had a two-tier structure, optional structure of 5% without credit, except same line of business, 12% with credit. Now that 12% has been increased to 18%. So these are the changes that one has to take note of, largely pertaining to the hotel industry, the transport industry, and this third, again very significant, job work industry. In case of job work, there are concessional rates for job work related to the notified items, but there was a residual rate of 12% for job work for registered person. The residual rate is now increased to 18%. So any job work transaction which is undertaken related to the goods which are not specified goods in this notification, then those job work transactions would now attract 18% from 22nd of this month. So this in a way will again escalate the inverted rate structure that we discussed earlier, because there are so lot of industries that we are aware of where their output tax is brought down to 5%, the input remains 18%, and the input services in the nature of job work, which was today attracting 12%, will now start attracting a higher tax of 18% from 22nd of this month, with the caveat that the refund of input tax credit is only available qua inputs and not qua input services or capital goods. So there the problem of escalation of the accumulation of credit would get would be increased in that context. There is a reduction in the GST rate as far as services related to the affluent treatment is concerned. This is again something in line with the government's push for the environment, the concern and care for the environment. So it is in that context that the affluent treatment services, which otherwise attracted 12%, will now attract 5% going forward. Again, this is a change where probably those who are interested in watching live IPL matches will now have to shell out more money, because the IPL matches which otherwise attracted 28% will now attract 40% of GST. So those who are going to watch IPL next season will have to pay a 40% GST at par with the GST that you might pay on buying a high-end vehicle, or at par with what you might pay for consuming unhealthy items such as the caffeinated beverages, etc., etc. So IPL is now at par with those kinds of transactions. So there will be a GST of 40% on the IPL tickets that we will see. next year onwards. Exception is only recognized sporting events, so sporting events like cricket, World Cup, etc., which would get notified in times to come. Those will attract a lower tax, the regular tax rather. However, the sporting events like IPL is what will attract higher rate. Again, events, places like casinos, mainly related to Goa and Sikkim, race clubs in certain states is permitted. So there also again, the rate is increased from 28% to 40%. As you are aware, online gaming, already we have seen the legislation which has been passed by the parliament where substantially the money online gaming has been banned. Even where, if let us say the online gaming comes under the exception category, there again the rate of tax is increased to 40%. So in a way, those sectors where the as a society, the government does not want to encourage, the rates of taxes have been increased to 40%. So this is largely how the rate notifications have been amended vis-a-vis services. Then we see the rate notification amended vis-a-vis services in terms of introducing certain exemptions. Largely the exemption is in the context of life insurance service, which is provided to an individual or the family. So that is now exempted for premiums which you will pay or which will become due on or after 22nd of this month. Health insurance similarly to an individual or to the family will be exempted on and after 22nd of this month. Then these are the parallel IGST rate notifications. This is just to complete the documentation. We have kept this as part of this compilation. These actually mirror the CGST notifications that we have already discussed at length in that context. Now let me just take up last two aspects: the compensation cess notification and the circular which have come, and that puts an end to discussing all the documents which have been issued by the government till date pursuant to this GST 2.0. So let me take you straight away to the compensation cess issue. Now, this is that notification. Now see, compensation cess, again industry is suffering because of two things. One is the compensation cess is abolished in one sense, and it is subsumed in another sense because the goods which attracted compensation cess, largely vehicles, they otherwise attracted 28% GST and a cess in addition to the GST. Now the smaller vehicles where the petrol, the capacity is not exceeding 1200 cc or where the length does not exceed 4000 mm, those vehicles will attract a lower GST of 18%. Rest all vehicles are now going to attract a higher GST of 40%. So effectively, the government indicated that we are subsuming the cess, which was separately levied as on date, 28% GST plus 12% cess, is now effectively subsumed into a rate of GST of 40%. And therefore, everyone expected that the government will permit the carry forward of the cess credits which are lying with these automobile dealers, automobile manufacturers, and you permit the utilization of those cess credits against the GST liability of 40% that will start accruing from 22nd of this month. But that didn't happen. Nowhere in the press release it was indicated that there is an intention to permit the utilization of cess against GST. As on date, the GST Compensation to State Act, which governs the levy of the cess, has a restricted provision in terms of section 11 subsection 2 proviso, which says that credit of cess cannot be utilized for paying GST. As on date, that remains in law. So as we speak, the cess credit will not be or cannot be used for discharging GST, a higher GST which would be levied on these vehicles from 22nd of this month. So already the vehicle industry, lot of forums have already written. Let us see how the government or the GST council will look at that. But as on date, largely the credit would not be available for utilization. So that is why we are seeing since last 5-6 days, there is a rush with automobile dealers to clear this unsold stock, because if they sit with this stock and on 22nd, not only they will lose the credit, but they will end up paying 40% GST. So effectively, the rate of tax on those vehicles which remains in stock on 22nd will be much higher than the fresh stock that they will receive on or after 22nd, and therefore we see that there is a huge push which is going on in the market, and that will continue for next 2 days to liquidate the unsold stock, to liquidate the stock at a discount, because they see that if that is not liquidated, then it will entail a loss for those dealers or effectively the brand owners, the manufacturers of this vehicle. So it is in that context that we are seeing every day huge advertisements being doled out for that reason. So that is first issue. Second interesting issue is like this, that let us say today a motor vehicle dealer is going to sit with 50 cars in inventory on 22nd. He would have paid cess, he would have consumed the cess, he would have utilized the cess against discharge of other cess liability on the sales that he would have done. And today the balance of cess that would be available may not be equal to the 50 cars that is available in the inventory. So let us say a cess on those 50 cars was, let us say, 5 lakhs hypothetically. The cess balance that would be available at the end of 21st of this month would be probably 3 lakhs or 2 lakhs or 3.5 lakhs. It would not be equal to 5 lakhs. The question arises is that in that situation, that balance will be lost, what we discussed as issue number 1. But whether these dealers will have to pay 1.5 lakhs or the shortfall to the extent of cess which is attributable to those 50 cars which are available in stock on 22nd. Now the views are divided. One set of views are taking a view that the dealers will have to pay that balance cess by cash, by depositing the money in the cash ledger of the cess account and utilizing that. I would take a view that that requirement might not arise. Now, why I am saying that? See, if you look at the law, section 18.4 creates this obligation that if some supply becomes wholly exempt, then in that situation there is a requirement of paying the tax. In this context it would be cess, because those provisions would be borrowed under the cess act. There is a obligation to pay the cess on those unsold stock which remains on at the end of 21st. Now 18.4 uses the expression when the supply becomes wholly exempt. Now, is this a case when the supplies become wholly exempt? If you see the definition of exempt supply under clause 47 of section 2, it defines exempt supply to include nil rated supply as first category. Second category as supplies which are wholly exempt under notification 11 by 11 of CGST Act or 5 of the IGST Act, 6 of the IGST Act, or they are non-taxable supply, right? Now, if you look at this notification, which you can see on your screen, 2 by 2025, it does not wholly exempt the vehicles from the levy of cess. What it does is that it makes them liable to tax at nil rate. So they are basically essential nil rated supply, not wholly exempt supply. Therefore, to my mind, section 18.4 cannot apply in this situation, because that applies only in a case where the supplies are wholly exempt. The government has not removed the charging provision from this goods. They have said that the goods will attract the cess, but it will attract the cess at a nil rate. Therefore, to my mind, there is a distinction that has to be drawn between a nil rated supply and a wholly exempt supply. We have some judgments in of the pre-GST era where the Supreme Court has examined this difference and has held that nil rated supply are distinct from wholly exempt supply. So applying that ratio, one can very well take a view that in such situation, only the balance that is available with those dealers will lapse, but dealers should not be made liable. Lapse in the sense that they will not be able to utilize that for paying the GST on or after 22nd of this month. But the balance, but to say that qua the inventory which is there, they will have to make the cash payment of the cess which already was availed in the past and it was utilized because of section 18.4, to my mind would not be right. So that is something that one has to consider while applying this notification 2 by 2025. Now the last agenda item is this circular which have come. This deals with the secondary or post sale discounts. Essentially what the circular says, that if let us say you have received the supply at a value of 1 lakh, there is an 18% GST, 18,000, and now the supplier issues a credit note, either a financial credit note or a tax credit note giving a discount of 10,000. And therefore you will now be making a payment. Let us say if there is a financial credit note, 90,000 is towards the basic value and 18,000 towards GST. Question arises is that whether the recipient is liable to reverse any input tax credit to the extent of the amount which was effectively not paid. The view has been that effectively it is not a case of failure to make the payment. It is basically by way of a credit note, the transaction value, the sale price is adjusted, and therefore it is not a case where there was a failure on the part of the recipient to make that payment of the consideration. And therefore, since the law permitted the credit of entire tax charged, and since the tax charge was 18,000, the view was that the credit of entire 18,000 would be available. Now the circular 251 accepts that view and holds that in such situation the entire credit of 18,000 would be available. There will be no reduction of tax credit if there is even if there is a reduction in the transaction value because of the issuance of a credit note. So that is first clarification. Second clarification that the circular indicates is like this, that if let us say there is a brand owner which gives, let us take the example of mobile phones. So there is a brand owner, let us say company like Samsung or Apple, which ultimately sells the goods to the dealers, distributors, which in turn sells the goods to the consumers. Now, if let us say, considering the competitive factors, if Samsung feels that there are certain inventories which are lying with the dealers, which are not moving, and therefore the price are to be reduced so as to incentivize the customers to come to the shops and purchase those mobile phones, the Samsung gives additional discounts to the dealers. The dealers in turn gives the additional discount to the customer. Since the relationship is independent between Samsung and their distributor and between the distributor, dealer and their customer, the view was that whatever discount that flows from Samsung to the distributor is independent pursuant to the contractual relationship between the Samsung and the distributor, and therefore it cannot be said that the distributor is receiving consideration from Samsung on behalf of the customer, and therefore the view which the revenue used to take by saying that this amount which the distributor receives from Samsung is on behalf of the customer by selling the mobile phones at a lower rate, and therefore GST on that amount also should be paid. That view was incorrect, and now the circular echoes that point by saying that in such situation, if both the relationships are independent between the brand owner, manufacturer and the distributor dealer, and between the distributor dealer and their customer, then it cannot be said that the brand owner or the manufacturer is making the payment on behalf of the customer in absence of any contract between the brand owner and the customer. Therefore, to that extent, the circular rightly takes a view that in such situation, the distributor will not be liable to pay tax on the amount of credit notes which is received from the brand owner or from the manufacturer. So in that context, serial number 2 addresses that issue. Serial number 3, however, creates the challenge. Serial number 3 in a way says that if let us say the distributor undertakes certain specific sales promotional activities, like he undertakes certain advertising programs, he undertakes some co-branding activities, some customization services, etc. And basis that there is an explicitly stated in the agreement that there will be some amount which would be payable for this activity, which are part of his dealership agreement, where the relationship is of purchase and sell, a buyer and a seller, then the circular takes a view that in that situation, this amount which will be paid by the brand owner to the dealers would be liable to tax. Now, I have some reservations on this view for the reason that under the agreement, there is a subtle law. One cannot pick and choose certain conditions which are imbibed in that agreement and consider it as a separate commercial transaction, as a separate independent activity, and make it liable to tax. Effectively, one has to see under the umbrella under which the transactions have happened. And if the basic umbrella under which the transaction has happened is that of purchase and sale, and even if as a part of that umbrella, if certain conditions are put on the dealer, and on fulfilling certain conditions, some additional amounts are ultimately adjusted to the original sale price, it continues to be required to be considered as an adjustment of the sale price. It cannot be considered as a separate transaction, as a separate contract, as a separate supply, so as to be brought to tax. So this aspect has to be noted. One will have to examine the contract in depth, understand the clauses under which the financial transactions are happening, and then arrive at the conclusion as to whether that transaction can be considered as an independent understanding or as a part of the larger understanding of the purchase and sale of the underlying goods in question. So that is first aspect. Second reservation that I have with this circular is to the effect that this under serial number 3, it also clarifies that if there is an agreement between a brand owner and the customer, and basis that if some financial payments are made to the dealer distributor, then they say that it would be liable to tax. Now again, this is a very generalized way of clarifying this particular aspect. Let us look at the case where, let us say, automobile dealers are involved. Automobile dealers, when they make a sale of vehicle to the customer, there are agreements which are entered into where there are certain obligations of the dealer to the customer, and there are certain obligations of the manufacturer towards the customer. Let us say a Hyundai car is getting sold by the dealer to the customer, then not only the dealer becomes liable to the customer for certain conditions which are there in the contract, but Hyundai, being the brand owner and the manufacturer, is also liable for any defect, for any issues during the warranty period, which is given by the brand owner, by the manufacturer to the dealer, to the customer. Now, in the meantime, if let us say there is a defect and customer goes to the dealer, customer pays certain amount to the dealer at a reduced rate because of the fact that the transaction was under the warranty, and that dealer compensates the difference from the manufacturer or from the brand owner. The circular takes a view that in such situation the dealer will be liable to pay GST not only on the actual amount that the dealer has received from the customer, but also from the additional amount that flows from the brand owner or from the manufacturer to compensate for the difference that the dealer had to face or the dealer had to meet in view of the fact that the warranty was given by the brand owner or the manufacturer. So again, something that one will have to require to examine the agreement to really see that exactly what is the legal relationship when this transaction happens, and accordingly this clarification can be applied. This clarification to that extent to say that generally in all such cases the value will have to be added is something which will have to be reconsidered. So this friends, then I have indicated in this compilation the FAQs. Largely they are generic in nature and therefore does not require much analysis. So with that, I think friends, I have been able to complete all the notifications which have been issued, circular, FAQs where I felt are controversial, where we dealt with the issue related to the admissibility of refunds, etc. So with this, I thank again Virag Bhai for inviting me, for allowing me to share my thoughts on this topic. Virag Bhai, you can take it forward now.
Thank you so much, sir. It's amazing marathon session. You're continuously speaking without even water break and taking and covering all the aspect of GST 2.0. Thank you so much, sir. Well deserved vote of thanks. We have so many comments and queries as well from the participants on our this portal. Go to webinar as well. Many are requesting for the presentation, sir, PDF, which you already told that you will share with us and will share with the participants. So that is one of the thing. And let me read the comments. Hardeep Singh is, thank you so much, sir. Special thanks. Great session. Sir, even you can read from the question tab. The above question tab is there,
Okay,
and it is
sure,
there
sure.
all
Let
the
me,
comments
yes,
and
yes,
few of the question as well. Sir, if you allow, can we take a few questions from the participants, sir?
sure, sure.
Yes. So, would like to request participants to post your question in the question tab. Few of the question we can take. We have a few minutes available with us, and sir is ready to take a few of the question. So, we can take few of the question. So, let me check the
Can
portal
I
available.
just quickly go through the questions so that it can be easier, if
Yes,
that
sir.
is
Yes,
okay?
sir. Sure.
So first is invoice raised before 22nd, but credit note for that invoice raised. So as I indicated, look, if the invoice is before 22nd, then certainly the credit note for adjusting the value based on discount, etc., has to carry the old rate. Then let me see. Where are the questions? Uh, Doctors who are providing services of cosmetic and beauty treatment. See, basically, healthcare service continues to remain exempt. So one has to distinguish between a healthcare service and a cosmetic and a beauty treatment service. If it is a cosmetic and beauty treatment, the rate of tax has been reduced now to 5%. If it is a healthcare service, it will be exempted. So in that context, one has to apply. E-way bill, do we need to generate? I have already dealt with that. E-way bill, you don't have to generate again if your movement has started prior to 22nd. We account for the purchase basis of receipt of the goods. If the goods on which rate has reduced on after yes, ITC fully is available. So even if the goods have started moving before 22nd, carrying a higher rate, if you receive it after 22nd, input tax credit or whatever tax charged would be available with you. So it is not the case where after 22nd you will get a limited credit. You will get full credit of whatever is charged. Then anti-profiteering applicable. As I said, no anti-profiteering provisions as on date are not applicable to this rate reduction. GST on school books, uniforms. There is as I understand, on school books, I think the exemption has been granted. On uniforms, you will have to check from the rate notification, but as I understand, it has been brought down to 5%. But again, I would strongly suggest you check the rate notification, which is part of this compilation, to exactly understand your particular item. Then I think this completes the questions that I can see. Just to clarify, goods which are exempt as from 2 by 17 continue to. No, see, 2 by 17 now is scrapped. So from 22nd onwards, you will have to look at the new notification 10 by 2025. And accordingly, you will have to apply the exemption. So you cannot now continue to look at 2 by 17 on and after 22nd of this month. This is please comment on for which first time different rates being given to end use house seller or paper that buyer use. So again, see, end use based exemptions are always problematic, because whenever an end use based exemption comes in law, it is always a challenge of gathering evidence to justify the end use. But if you are able to demonstrate by way of the market parlance that the end use of your product is to what you are claiming, a misuse committed by the recipient would not be the factor on the basis of which revenue can sustain their demands at a higher rate of tax. Having old stock with MRP, see, as far as MRP is concerned, it's a good point. Initially, when this notification, before issuance of notification, we had received one notification from the legal metrology department indicating that you will have to show a revised MRP sticker with the old MRP visible. Now we find that yesterday a new notification have come by the legal metrology department, where they have said that it is not mandatory. You have to just publish the lower rates of taxes. If you are lowering your price, you have to publish your lower price at whatever store or shop from where you are making the sales. There is no need to affix the revised MRP stickers on the stock which is available on 22nd of this month. So again, this is a welcome clarification. See, as far as cess on coal is concerned, that again has been subsumed now. The rate of tax on coal has been enhanced from 5% to 18%. So again, there is the same challenge that for the stock of coal, where you would have paid cess of 400 rupees a ton, what will happen to that? So there again, same what we discussed for the automobile sector. In absence of any provision permitting the usage of cess against GST, the cess will continue to remain and sit with you in the credit ledger. So I think, Virag bhai, that completes whatever I can see on the screen.
Yes, sir. Yes, sir. Sir, there are lots of updates every single day in our profession, and we have to keep updating ourselves. And you are making us every single time, at least in GST, you are running the Google group as well, and we are receiving your inputs as well, the presentation, your PDF, your presentation. So even we are not able to listen you all the time because of the limitation, because of your time, because you are taking a physical session and upgrading knowledge of the participants, but still we are connecting on a virtual mode on your email, and we are receiving your updates at least on GST. And today also there are so many updates we received. Just for the information of the participants, that ICI has made voluntarily for the non-corporate entity format and also LLP format as well for this current year. Again, other updates on charity commissioner returns in Maharashtra. It is also the due date is 31st October. But sir, when I am receiving many messages and calls and talking with many chartered accountant about the portal issue which is going by them in last 10-15 days for the at least for the income tax purpose, but people are asking even for the GST same as well, because already more than 5.5 months passed by when the financial year completed, but even the GST portal is not ready for
Right.
9.9C submission. And when we will approach the due date, again it will chaos will create for the same. There are so much cost also involved by the government already given the tech companies, but they are not prepared yet, and we may face again difficulty in that. So any of your comments for the this kind of issue, what we can professional, because every time blame become came to professional only, chartered accountant and tax professionals. And let me tell you sir, in today's our session, many chartered accountants are there, but apart from that, many tax professionals are also joined from the across India, tax lawyers and advocates and solicitors as well. So your comments, sir, on this aspect as well, sir.
See, as I already indicated, like for example, in GST, where we are seeing now yesterday's notification amending Form 99C, God knows when those forms will be available live on the portal. And these are amended forms which are applicable for 24-25 financial year. So we only
Right.
hope and pray that at the earliest they make it available so as to not make lives of professionals miserable. The only way we see to remedy this is that we have to also be wise enough to pick our clients. It should not be the case that every client which comes to our door is something that we should, because ultimately it is a joint responsibility. It's not just the responsibility of the professional to ensure that the forms are filed in due date. And at the same time, we cannot also let our health deteriorate, our mental well-being deteriorate because of the delay at the end of the client, etc., etc. So in that situation, we have to be very clear and transparent in our communication. Suggest the deadlines within which only if the data comes to us, then we are going to execute, and the clients also have to learn this aspect, and basis that only one should have a, because professional life is one aspect and there is a personal life, and that has to be balance has to be maintained. So that is very important. One has to also respect the client, but at the same time clients are also required to respect the professional. It cannot be just a one way street.
Absolutely, sir.
Right.
And sir, for your session, we are receiving still many comments and appreciation. Geeta madam is also appreciating. Thank you, sir. Very informative session. Sir, just last question before we end the session. As you are practicing, I mean, basically you are appearing, not as in practicing also, but appearing is a better, I would like to say, in a high courts, in many high courts. So people are, as of now, worried apart from GST for tax audit as well, and have received messages that few of the high court, I mean, the advocates has already filed the writ petition in the high courts. So, how
Right.
judiciary will think about this aspect, as per your past experience and what you can see for this current year as well, sir? For particularly on tax audit, if you can say anything about judiciary mindset.
See, generally what I see is that there are genuine reasons why taxpayers are unable to file the returns. And mainly those reasons are attributable to the system issues at the end of the government. The unfortunate part that I see is that the government, when they extend, do not recognize their problem. In fact, they say that it is as if that they are granting some kind of a favor to the taxpayer by making whatever extensions which are again found to be inadequate. So a trust can be created between a taxpayer and the government only if the government also openly admits that yes, there are technical challenges. We are looking into it, and accordingly, we are also remedying it by way of giving the extended timelines, saving, creating exceptions from imposing interest, penalties, late fees, etc. Only in that climate a country can progress. We cannot have a climate where everywhere we keep on litigating, where government does not acknowledge their problems and forces the taxpayer to knock the door of the courts. Courts ultimately issue notices to the government to come and explain to the court why these errors are there. Then they realize, and then they address that situation and probably remedy that issue. That is not the ideal way in which a country can function. So ideally, they ultimately have to do it, because once the matter is in the court, better they should do it before that stage reaches. So, and as a
Right.
society, only we have to wait and for that maturity to come. As a society, we all are part of that same society.
Yes, absolutely, sir. So again, thank you so much, sir. We have received appreciation from Prakashji. Also, thanks, sir. Again, Hardeep ji, superb session, best session on GST 56 Council meeting. So there are many comments for you, sir. So with
Thank
this
you so much.
appreciation note, we are concluding our today's session. Friends, you will receive the presentation, and the recording will be also stayed on the Connect Easy YouTube channel. So if you like the video there, the YouTube's ecosystem will again spread between the professional or whoever searching for the similar video. So it will again benefit for the professional. So with this, we can conclude our today's session. Again, there are many comments. I am not reading all from Sanjay ji, from Prakash ji, and many all. So would like to request everyone to connect Abhay sir on LinkedIn, and sir would like to request you also to give your email ID at least, so that people can connect you, or if they have any query, they can message you, because
Sure.
some query may come later, or whoever watched the recording, if they want to connect with you, so they can email their queries, or there is some issue as well. So
So with the compilation, I will share
members,
that email address.
yes, so members, you can connect with sir over email once the presentation sir will share, and will share with everyone who has attend or who has registered for our today's session. With this, thank you once again, sir, for amazing session, and
Thank you so much.
we'll meet again and again. We'll invite you also again and again, sir, and to all the participants for future more session on our profession on all multiple aspect, GST, income tax, taxation, apart from that, valuation, and every topic, obviously a technology as well, AI and other topics as well. So thank you all, thank you once again, sir.
Thank you so much.